I will even go back a bit earlier. Why was a guy like me hired by an investment bank in the 90s? I never really had I was not invested in financial affairs at all. I remember when I was interviewed by the bank, they said, well, we've never experienced a guy who knows so little about anything like you guy. But somehow I was like a math guy. I understood math reasonably well and models. And back then the belief was if you enter into a derivative, and I say that in a second what it is, then you need actually quants and mathematical geeks, what I believed, on Wall Street in order to price these type of risk, to evaluate these type of contracts, complex contracts. But the interesting part about derivatives is they've been around since forever, the futures market, but like the OTC, the off market, the over-the-counter derivatives are around since the 80s, late 80s. And pretty much it means, let's assume, Robin, you and I enter into a contract and we can say, okay, different interest rate contract. I'm going to pay you for the next 10 years 4% fixed, and you pay to me 3-month rate every 3 months is being reset. So of course, I know my outlay for next 10 years, and if rates are rising, you lose. If rates are falling, you gain. So, and this is the simplest of derivatives. And in order to price this transaction, in order to trade this transaction, you need sort of like people understand mathematics or physics or astrophysics reasonably well. That was the premises of the idea. Interesting as well, this system is based on trust. So you and I enter into a contract, and now you and I sort of like understand what the valuation is. Because on a daily basis, there's going to be exchange of money. If I'm in the money, so my contract is up, you have to wire money to me. If in your favor, I have to money to you. So it's like a trust system. So what happened then in the financial crisis? And by the way, it was something which the Fed was actually, and the central bank of the United States was very proud of developing in the 90s. Alan Greenspan, I think he gave this very famous speech in 1999, where he said, thanks to the innovation in derivatives market, which he didn't want to regulate, we are able to actually smoothen our financial system because we are able to unbundle the risk and distribute it to different people. That was the theory, which blew up in the face, big time. So what happened then in 2005-06 was after the dot-com shock, the first big shock for many, many years for the US capital markets, rates were lower and everybody got involved in the property market. Bill Clinton came up with this, what he thought a good idea in the 90s, that every cab driver should own his own house. But somehow, if you're a cab driver, self-employed cab driver as an example, you don't have the means to buy a house. So therefore, he said, well, we have to lower our lending standard. That's called the subprime market, not subcrime, which some people say was the same. So subprime market. So pretty much lending to people with not great credit score or no credit score at all. And that was the asset class I traded then. So I worked for Morgan Stanley, I went to Lehman Brothers, and in 2004-05, I went to Deutsche Bank, where I worked for Craig Lipman, alias Ryan Gosling, Big Short. And my task was to develop the derivatives market for subprime, which I did. And we traded a lot back and forth, like selling the risk, buying the risk in any direction. But what we could see early on was there's a crack in this market because this market is much more riskier than people believe. So we started betting Craig and I working for him against this market. So our view was ultimately this market will collapse. We didn't really expect it's going to go the way it went, but we expected there's massive risk, and we communicated very clearly and openly to investors. It's like the parallels to Bitcoin is quite interesting. So we're very open. We say, guys, I think there is a risk. We are in a business to make markets, so we buy and we sell. But you guys want to be a bit more careful because ultimately it's highly concentrated. the same risk. And now it's interesting. The biggest bank, Wall Street Bank, with the smartest people and highest paid traders, they were always like, no, that's going to go up. It's going to go on forever. So we've seen massive trading volume, massive interest in this product from all the investors. But we didn't have even enough cash bonds to satisfy the demand which was out there. So that's where I came in. I created derivatives. So in a synthetic version, if you say, for example, Robin, you say, I want to have exposure to this subprime bond. Now we don't have the bond, but I say, listen, now the problem. I'm going to give you to you in derivatives format, which means I pay you whatever the subprime bond pays. But if the bond defaults, then you pay me the recovery rate, like my 1 minus recovery rate or 100 back. So it's like an insurance contract. And that's a market I developed, and others, Goldman Sachs, Bear Stearns, as well, working with these firms together to develop this market. And what happened now in the financial crisis was, it's quite interesting. It's not dissimilar, I think, from today. There was a tremendous liquidity in the market in 2005-06. Nobody could see how could anything go wrong. But now I come to the point of trust. Suddenly people realize, whoa, this subprime bonds, they seem to be more risky than we thought. It started like end of 2006. So just before, a couple of months earlier, we entered into this massive transaction with Morgan Stanley. It's public, so I can say that. It's even in the book. In the movie, you can see this big trade. I work for Deutsche Bank versus Morgan Stanley. And so they say, we want to own 3 billion of that risk. And we say, okay, fine, we give you 3 billion, not in bonds, in derivatives format. That's what I did. For that, we have to pay you every year around 7.5 million. But if that goes wrong, you have to pay us potentially the full amount. Now, the film, I think, talks about that. We ended up with I think we paid them about 12 million plus minus over 1.5 years, and they had to pay us more than 2.9 billion. So I think that's the biggest gain for Deutsche Bank in history. And Craig got paid accordingly, according to the movie. Not so much me, unfortunately, but yeah. So it worked out. But that's an interesting part as well, which we can go to in the Bitcoin story. When it happened, this big trade between us and Morgan Stanley, we were really, really happy. We're like, high five. It's better than these guys from the other side, these assholes from these arrogant banks and blah, blah, blah. But suddenly we realized, it's like in a plane. We were right, but it looks like the whole system collapses. So from like being so happy and high five, we got really nervous. Anxiety kicked in for all of us to say, there is no winner. Why do I say that? I know Bitcoin Maxi talk about the end of the world, and like, you do not want to have this scenario. There's no winner. Even the guy who is right is ultimately the loser. So, and what happened at the end of the day, and during that time, I realized the system is massively broken. And one thing I've seen, Robin, is interesting, that the subprime market, which peaked back then, thought is a big thing, was only a 1.5 trillion market. It's not really a big market. It's like when you think about, I think the investable wealth is like 500 trillion, 600 trillion numbers all over the map, up to 900 trillion. I see different numbers. So it was like 1.5 trillion. Maybe back then the global wealth was like 250, 300 trillion. So it was like a fraction. But what happened is the trust amongst the players broke down, because we had all these derivatives contracts and nobody knew anymore who had which exposure. The banks didn't know, management didn't know. And suddenly we say, we are not entering, and that's the worst thing, we are not entering into a transaction with this bank or this company XYZ because we think they have an exposure. No, they turn around and say, well, we don't trust these guys. So suddenly from like a system built on trust, in literally no time, you have no trust. It's such an opposite to Bitcoin, where actually the foundation is a trustless systems, which is hard to break, or if at all, I don't think you can break it. Banking is a trust business, and trust can disappear in a nanosecond. One incident, one weird thing, some people say, wow, what's happening. And Wall Street operates like that. Wall Street is like the shy deer, where like, oh, what's happening is running away the other direction, and there is no market anymore. It just breaks down. And I think that was my realization. And then to finish the question in a lengthy way, what I learned as well during this situation was the following: the belief in senior people in the upper echelons. They know exactly what's going on. I think that's on a more general level, people believing in their government, believing in like these people, CEOs, companies know exactly what's going on. They're going to steer, or central bankers, they're going to steer the whole ship into the right direction. Well, what I could see, we were trading from the morning to the evening, working around the clock, totally stressed out, the traders. But when I looked towards the corner offices where all the big cheese were sitting in the corner office, they were steering at the Bloomberg terminals, and I could see and talk to some of them. They had no clue what was going on. They were shocked. Politicians were shocked. Central bankers were shocked. You couldn't really expect any help. And ultimately, the system was bailed out, which in my view was a massive mistake. I would have lost everything, but that's fine back then. But I think the belief that somebody knows what's going on, I think that's just wrong. I think you can only trust yourself and be accountable for your own actions. And you will make a lot of mistakes on the way. But to think that there is this like central banker who's going to bail you out, like Powell or like Lagarde in Europe or some politician, I think that's what I learned back then firsthand. People are being paid a lot of money. They're on the front page of all the newspaper, and they have no freaking idea what's going on.
I love that. And it's so interesting because most of my guests agree with that, and most of my viewers and audience probably also agree with that. But if you step out of the Bitcoin bubble, you really see that people trust in those central bankers and the bankers, and all they know what they're doing. They have the university degrees. They have been in banking since 10, 20, 50 years, whatever the number is, and they really trust in those systems. I'm always boggled by like how high the confidence of normal people still is in those papers and those institutions, when we have seen so many times in history that you cannot trust it. Like the evidence is really really stacked against them, kind of.
It is always. And one thing, I think capital markets is capital markets for me is a bit like Bitcoin. It's a very powerful, very resilient beast. Wall Street is a very powerful and resilient beast. Why? Because these guys, because everybody does whatever they do, trade and show and yell in the old days, especially. If markets blow up, then like a lot of firms go under, a lot of Wall Street firms go under. If you go into the list of like the big Wall Street firms from the 70s, you won't find, apart from Goldman Sachs and Morgan Stanley just made it, any other firm which was around back then. And Morgan Stanley and Goldman Sachs, let's face it, they got bailed out. So otherwise they wouldn't exist as well. So, but they constantly invent themselves. They always get involved in new things. And I love that. They move from A to B to C. And what's great about Wall Street, and that's not dissimilar from the Bitcoin scene, you can be a little guy at Wall Street. So I was like a very, very, like I was old in terms of age, but very junior in terms of ranks when I started there in the 90s. But you can become very successful yourself by being a successful trader, by doing be hard-nosed and doing something, and everybody does his own little thing. And it doesn't matter whether you're like the senior managing director or you're an analyst, you can make as much money as this back then, not true anymore, as the senior guy. What unfortunately happened, and that has changed after the financial crisis, governments thought and regulators thought, let's fix this problem of Wall Street by actually imposing more regulation, which is insane. So what was the outcome? I think the outcome is that we have much more systemic risk today than back then. Because one thing which hardly anybody knows, the banking system, and here now I talk as a former insider, is covered by apparently like very strict rules, how financial rules, risk mitigation rules, and risk management. So therefore, you should trust the system. And it's being set up in a way, and I think hardly anybody knows, there is a firm which is owned by all the central banks around the world. It's called BIS, Bank for International Settlement, based in Basel, Switzerland. People wouldn't even know what is that. Well, this institution actually is responsible for the regulatory framework for banks, how much capital they have to have, how the models have to run, and so on. So therefore, you might have read in financial news things like Basel 1, 2, and 3, and 3.5. So these rules, actually, is quite interesting, lead to the fact that all the banks tend on buying the same crap at the end of the day, because it looks great under this model, which being designed by this committee. And the interesting thing is there is one asset class which always has the best treatment, because this committee defines risk-weighted assets. So if a bank buys an asset, it gets a risk weighting. And it means if you have 100% risk weighting, you buy, for example, 100 million of a bond or loan, that means, and you have a risk weighting of 100, it means you have 100 million of risk. Against 100 million of risk, you have to have, right now it's let's say 10 million of equity capital. One asset class has zero risk weighting, which means you can have almost as much as you want. Government bonds. Hardly anybody knows. Banks tend to blow up actually on government bonds, because for them it's a wonderful way actually to place their government bonds and to let the system run. And that's being designed like that. So I think that's something where I can see even in the future massive blow-up risk coming from that. We have seen it, by the way, in Europe already. You're in Europe, in Austria, 2011 Greek government bonds, zero risk weighting, and we lost our shots, like banks and insurance companies mainly. So I think and here again, there's this belief you have complicated models. I mean, people talk about Bitcoin, oh, it's complicated, it's very tough technology. Bitcoin is actually very easy. It's the code is I haven't read a code, but it's not that long. I know the key elements. Compare that to a financial institution like a bank, where you have the central banks behind, and you have this complex models, which, by the way, being a math guy, and I understand some of these models, you can arbitrage them like crazy, that I wouldn't even believe. I think that's really a danger, because then suddenly you have people getting involved, as you said, Robin, with PhDs, smart, being paid so much money, they know exactly what's going on. I tell you, these people have no freaking idea. They're really, you always should trust a hardcore, simple Wall Street commodity trader with a beer belly, talking rough. These guys you can trust. These people with PhDs, or happen that I have one, but usually, and talking the big gains and model, do not trust them.
Thank you for watching this video. This was only a snippet of the podcast. And if you want to watch the full episode and get all of the context of this episode, you can click right here or here. Oh, maybe also here.